Hello and welcome to Portfolio Matters Weekly Update, Week 32. But before we get into it, Richard will read the disclaimer.
Thanks, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. I think we've got a full week this week, haven't we, Keith? Take it away.
We certainly have. Well, thank you for reading the disclaimer with such speed.
I thought I should get on with it. We're now going to start speaking at double time.
First of all, apologies for the sound quality issues last week. We believe we have sorted them. Okay, it has been a very busy week in the terms of data and also news. So this week, Biden got his $1 trillion infrastructure bill through the Senate and is now attempting to get a $3.5 trillion budget through as well. So the Biden administration is going full speed ahead with fiscal stimulus, basically. In addition, Biden called on OPEC to increase oil production because he feared that gas prices at $3 a gallon were going to be a drag on economic growth, which is rather ironic given his administration's
green credentials.
Attempts to curb US oil production. Okay, into the data. So we had June UK construction numbers that was up 30% year on year, which was well down from May and slightly below consensus expectations, but still very strong. UK industrial production for June was down 0.7% month on month, which was well down on May when it rose plus 0.6% and also very substantially below expectations. Expectations were for it to continue growing at plus 0.5 and it shrank by 0.7. That's not good. But then we're seeing return of COVID in June and various supply disruptions. Okay, moving on to the US. Well, the big news this week was non-farm payrolls, which came in hot. So the US added 943,000 jobs in July, which was up on June and beat expectations substantially. Expectations were only for 870,000. So that's very positive. The US economy seems to be doing well. And the US unemployment rate fell to 5.4%, down from 5.9% in June and below expectations of 5.7%. So that is also very positive. Unemployment is coming down quickly. And the labor force participation rate was 61.7%, up from June and above expectations. Average earnings were up 4% year on year in July, which is up from June and up on expectations. Expectations were only 3.6%. So wages are growing faster than previously expected, and that is very inflationary. 4% wage growth will lead to inflation well above the 2% Fed target. Okay, job openings for June in the US were above 10 million, which is well up on May and well above expectations. So the US labor market seems to be very strong. Inflation numbers in the US, we had inflation of 5.4%, which was the same as June, but above expectations. The expectations were for it to come down slightly to 5.3%. Core inflation fell to an elevated 4.3% from 4.5% in June, and that matched expectations. But bear in mind.
So I just chip in there. What I find interesting here is that if you look at the consensus expectation for US inflation rate, 5.3%. What was the consensus expectation 8 months ago? I don't know exactly, but probably 2%. And what it makes you realize is that the consensus expectation is basically not a useful number, except if it's missed, the market reacts.
That's precisely right. Yes. Yeah. So it's the expectation of where this month's number is going to come in. And all these numbers show that the market and consumers have become used to these high numbers.
Yeah.
So if we look at the US consumer inflation expectations for the coming year, they're expecting 4.8%.
Yeah.
So inflation expectations getting baked in.
And they're getting baked in quite quickly as well.
Yeah. And so if US workers start to demand wage rises to match their 4.8% inflation expectations, then you get 5% inflation baked into the system, essentially.
Yeah.
In China, we had inflation numbers and they were low. So Chinese inflation rate was 1% in July, down from 1.1% in June, but above expectations.
Without dwelling on this for too long, because we have got a lot to get through, I'm not quite sure if I believe the Chinese inflation rate, because food inflation is significantly above 1%, yes. And they are subject to food inflation, and commodity inflation is very significant at the moment. So I don't quite understand where they've got their number from.
Yeah, true. There's always a problem with all Chinese data is politically manipulated, we would say. EU industrial production. Now, these numbers are interesting. In June, month on month, EU industrial production fell by 0.3%, and it fell 1.1% in May. And the June number was slightly below consensus expectations. And we will see, when you see the chart, it seems that EU industrial production has largely stalled over the last few months. Now, there are lots of supply chain disruptions, etc., but it's concerning. Okay, so let's look at some of the charts relating to those figures. So this is the US unemployment rate, and it is coming down quickly. The continuing jobless claims are also coming down quickly. Job openings are going. And this is US consumer inflation expectations, which have gone up very quickly and are stabilizing at well above 4.5%. And this is US inflation and core inflation, which ticked down a tiny amount last month. But
it's interesting, isn't it, that the consumer expectation for inflation basically follows the inflation, almost follows the inflation line. It's gone up just as quickly from a standing start.
Absolutely. But that suggests, Richard, that if inflation comes back down again, consumers could adjust quickly to that.
That is true.
Right now, their wage inflation is rising.
Yeah, that's true, Keith. This is a little chart that I thought was really interesting. It shows that core goods price inflation is as high as it has been since the late 1970s. And as we know, the 1970s was a very inflationary decade.
Yeah. Wow. This is Chinese inflation rate, which seems very counterintuitive to me.
Yes.
It's inflation is very subdued, whereas inflation seems to have been very high in 2020 during when there was significant COVID disruption. So perhaps they're ahead of us, but anyway. And these are the EU industrial production numbers, and you'll see essentially this year they're completely stalled. We've had no industrial production growth in Europe this year.
Yeah.
So that is concerning. But in previous weeks, we've seen that consumer and business confidence in the EU is very high.
Overnight, the Federal Reserve overnight repurchase agreement. So this is the amount of money that the US banks deposit at the Federal Reserve overnight in order to get their 5 basis points interest rate. And Keith and I were discussing this beforehand, and it is they would prefer to put their money with the US Federal Reserve to lending it to each other overnight, because they consider that the Federal Reserve is safer. It also means that they are concerned about the risk of lending it to each other. And I think the Federal Reserve is probably encouraging them to do this, isn't it, Keith?
Yeah. No, it's certainly part of their policy, but this shows that the US banks prefer to lend to the Fed than they do to the private sector.
I think the interesting thing about this chart is it's effectively showing a discontinuity in behavior, and a large discontinuity at that. And I think discontinuities are always dangerous for an economy because you don't actually know what the knock-on effect will be or when it will arise.
Okay, let's go into the US jobs report, which was very strong. So this compares the permanent job losses during the recent recession with a couple of previous recessions in 2001 and in 2007, the Great Financial Crisis. What it shows was, compared to the Great Financial Crisis, far fewer jobs were lost, and the rate of recovery seems to be much faster so far. So once all the restrictions come off, it looks like the US economy will just self-heal. And this is the same chart, but for all post-World War II recessions. And so I see massive job losses, but then very fast recovery.
The only question mark I would raise there, Keith, is that the trajectory could level off and move more to a more gentle movement to get back to zero. We don't know that the trajectory is going to continue at that very steep angle. It may do, but it remains to be seen whether it levels off a bit.
Well, the thing is, Richard, when you look at the job openings, those job openings were enormous. It looks like, as soon as people feel that they can go back to work, that it's safe to do so, then I think you get a very strong recovery. Now, this chart is quite complicated, but essentially the big yellow line is job openings. The dark blue line is the number of actual hires. You'll see that there are far more jobs, people looking for jobs, than are currently being hired. So if you want a job, there are plenty available. And as a result of the fact there are lots of employers looking for employees, wage growth is very strong, certainly in certain sectors. In retail, you're seeing wage growth of, is that 11%?
Yeah.
And in manufacturing, that's 7%. So in those sectors, you're seeing wage growth far ahead of inflation. Now, obviously, there are certain sectors which haven't opened up yet, such as hotels and leisure.
So one interpretation you can also make in this graphic, Keith, is that if you look at when the wage growth initiated, it was probably May 2020, but the core inflation didn't really start to pick up until about 6 months later. Wage growth has stabilized, core inflation is continuing to go up. The question is there now going to be another kick up in wage growth in response to the core inflation level, thereby producing this self-perpetuating inflationary spiral?
Yeah. We'll have to wait and see, Richard. That really is the big question, isn't it?
Yeah.
If wage growth picks up in response to inflation, we get an inflationary spiral.
Yeah.
And as a result of all that, US firms are expecting more wage inflation in the future. So 38% of firms are expecting somewhat greater than normal in wage inflation, and 10% were expecting much greater than normal inflation.
So this chart shows the labour force participation rate for people in the age range of 25 to 54 years old, and it was about 82%. This is the labour force participation rate as a percentage of the entire population, which is only around about 58%, which suggests that a lot of over 55-year-olds have simply opted out of the economy. There may be some inconsistency in the way the data is gathered as well. So it suggests that the economy is being driven by younger people.
Absolutely. And one of the side effects of enormous amounts of QE is you had a very strong stock market. Older workers tend to have lots of financial assets, which have all gone through the roof. And as we've talked about in previous weeks, a lot of people over 55 may simply have looked at the value of their stock account and decided they've got enough assets and don't need to work anymore.
Yeah, effectively, rather than participating in a social security plan, they're participating in a QE plan.
Yes. Now, this is the number of people who are working part-time but would like a full-time job. And what is interesting is that it is pretty much back to its lows of the last cycle. So it's basically the best point of the last cycle. And so if you're working part-time, but you want a full-time job, you can get one. There are lots of jobs available. And if you look at the speed with which the labor market has healed, compared to the last recession after the great financial crisis, I mean, it's back to the levels where it took 5 years of the recovery from the GFC to reach the same level. So we are recovering really quickly.
I think clearly the amount of government stimulus must be impacting the rate of employment recovery.
Yeah.
It's not a sort of natural healing process, if you like, natural in inverted commas.
Yes, absolutely. Well, we've seen, as we'll go into this in a few slides, Richard, but enormous fiscal and monetary stimulus. And as soon as you take the brakes off and all the COVID restrictions off, I expect the US economy and all economies to recover really quickly. Now, pushing back on something we've just said, though, long-term unemployment remains elevated, but I strongly suspect there's a strong sectorial dimension to this because hotels have not yet fully opened up, leisure sector has not opened up, and there are some sectors which are still being very strongly impacted by COVID. And if you work in those sectors, your job's not back yet. Okay, now moving on to inflation, because we also got inflation numbers this month, and this shows various different measures of US inflation, and they are all strong and they're all well above Fed 2% target. And if you strip out the outliers, the inflation numbers obviously fall quite a lot, but they're showing rising inflation that is above the Fed target.
Of course, stripping out the outliers is actually a totally spurious analysis because the purpose of the basket is it's a reflection of what the average person spends their money on. And you don't say, but we're going to take out the outliers. Well, it's nonsense. It's like it's a second order derivative of the actual inflation rate.
No, I completely agree, Richard. But if you want to pretend that inflation is much less than it really is, you say, well, it's only due to X, Y, and Z, and X, Y, and Z will come down. I mean, it suits everyone to talk about trimmed inflation, and it allows people to keep rates lower.
It does allow more manipulation of the economy. Presumably, washing machines and airfares are outliers, are they?
They're outliers, mate. Yes.
We don't need to worry about them then. I'm off on the screen to do the washing.
Yeah. Airfares could come down quite quickly if the airlines get back into full operation, but they've got enormous losses to make up, So I suspect they will try and keep airfares as high as they possibly can for a period.
Yeah.
Now, the big thing, though, as we've talked about before in the weekly, is that rents are rising. And as we go towards the end of the year, Nordea are expecting the rental component of US CPI, and bear in mind it's around a third, 30% of US CPI is rent. Their model is showing that you expect a big rise in rents in the second half, particularly towards the end of the year, which will lead to a big rise in US inflation. And as a result of all that, bond yields are starting to reflect higher inflation expectations, although not very elevated compared to where the inflation prints actually are. And inflation numbers generally continue to surprise on the upside throughout the developed world. So the blue line is developed markets G10 inflation surprises, and the white line is OECD inflation year on year. As a result, small businesses are having a hard time. They've got high input price inflation and they're finding it very difficult to hire.
Which means they're going to have to put their prices up.
Yeah, true. Or their earnings are going to collapse.
But if their earnings collapse too much, they can't afford to pay their bills.
That's true. That is true.
So,
but that the feed through to the stock market is that, you know, if companies can't pass on their input price rises, their earnings will collapse, and earnings expectations are very high.
But also that's great, because last week we discussed that chart which showed what the return was, the stock market return was as the inflation rate goes up, and I believe the cutoff was around about 6%, where the stock market starts to perform badly, and we're not very far off 6% now. Inflation.
True. The reflect this is the performance of inflation sensitive equities, and after a couple of poor months where the reflation trade essentially died, it appears to be picking up again on the back of the strong jobs report and continued inflation. And a quick reminder of what everyone knows. This is a chart showing the link between money supply growth on the x-axis and inflation on the y-axis. And the more money you print, the money supply growth equals inflation.
Just like to point out that this is 1999 to 2007. Current US money supply growth is around about 30% or something, isn't it? Which is going to stick it bang in the middle of those dots.
Yeah, well, it was 30%, but it's coming down, Richard. So
yes.
But the question is, going forward, we've stuck up base money. If the banks now start lending and the velocity of money starts picking up, then you'd see very strong money supply growth.
Yeah, heading towards Argentina, unerringly.
Okay, now, friend of the podcast, Stuart Owen, put me onto this speech on YouTube by Stanley Druckenmiller, which I thought was very good. And I've taken some screenshots from his speech. And when I was watching it, I thought, sometimes we overcomplicate things. And actually, the current macro economy is really simple. So if you look at the US fiscal deficit, you'll see that they've given the economy much more fiscal stimulus than they ever have coming out of any recession ever. And well, since 1980 anyway. And they're going to continue running a big fiscal deficit even as the economy recovers. And so this is the projected fiscal deficits over the next few years. And in the US, both sides of the House now committed to fiscal profligacy. Essentially, nobody is on for austerity or cutting back on the budget deficit.
Interesting. Also, keep looking at this really, really interesting chart. You can see how they're projecting that by 2031, 50% of the total deficit will be interest payments.
Yes. And of course, if inflation ticks up and bond yields rise, that could overshoot quite quickly.
Which is why the Federal Reserve can't allow bond yields to go up.
To the extent that's in their control, Richard.
I know.
Is the question.
Yeah.
So this is the outlook for US unemployment, and employment is rising quickly and unemployment is coming down faster than in any other recession. So why is all this fiscal stimulus needed?
So what this chart does is it shows from 2000 up until the present, the US nominal retail sales, and they've overlaid that with the receipt of stimulus checks 1, 2, and 3. So stimulus check 1 arrived when retail sales had plummeted at the time of the initial lockdowns with COVID. That money appears to have been spent shortly thereafter to take retail sales back up to trend. And then check 2 and check 3 appear to coincide with a dramatic increase in retail sales, which is telling us that the stimulus checks are being spent, not saved. That, of course, puts excess demand into the economy, which creates price pressure. And also, we know we've got transport pressure from various transport hubs, and the pressure on the transport system is causing transportation prices to rise. So this looks like, with the benefit of a bit of a hindsight, highly inflationary transfers from government to people's bank accounts. Keith?
Absolutely. Now, this is really interesting. And this, if you remember last year, there was a sudden stop in the US Treasury market, the largest and most liquid market in the world, for a couple of days during the COVID crisis in March last year. The market essentially ceased to function. And I had some US Treasuries that I need to sell, and I had a very, very small amount, and there were literally no bids. So, and that caused the Fed to step in with QE to fix the market. Now, Stanley Druckenmiller has got a really interesting explanation for what happened. So the green line here is foreign holdings of US Treasuries, and you'll see there is this enormous spike down in around March last year. And what he's saying is that when the US announced its $2 trillion CARES Act, that foreigners took one look at the massive increase in the US fiscal deficit and decided to dump treasuries. And the size of these sales are really unprecedented. And what's also interesting is that foreign buyers of US treasuries have not come back. So as the US continues to run a large fiscal deficit, who is going to buy them? It's going to have to be the Fed, in part, at least.
So this chart shows that the US fiscal spending plans are unsustainable. So if you look at 2020, we had the large peak in federal spending with COVID at around about nearly 20%, and then it has substantially dropped. But with the social security major healthcare programs continuing to increase at a steady rate, and the deficit slowly but consistently increasing, the net interest is projected to start to rise to a point where the deficit and the spending plans of government are completely unsustainable around about 2050. And the question is, given what Biden is currently doing in terms of deficit spending and his plans, how is the US going to get out of this? Because it is on an unsustainable path.
Yes. And anything that can't last forever doesn't. Yeah. The question is, how does this change?
Yeah.
Okay, so on to other charts. So thank you to our Discord member, Ali Baroid, for sending us this chart. And that shows that in Asia outside China, PMIs have come down quite a lot recently, actually. The white line is Malaysia, which is how it's suffering from COVID restrictions. And essentially, this all appears to be the Delta variant causing disruption in Southeast Asia. So we keep on thinking that COVID is at an end, but it ain't.
So I read this morning that the Sinovac, the Chinese vaccine, is about 50% effective. And that's a bit of a shocker, really, because it means that a lot of populations that have been vaccinated haven't got the protection that they thought they had. And it's going to have a big knock-on effect for COVID in those countries.
Yeah. Well, we look at the Chinese COVID numbers askance, given how much, 50% effective vaccine effectiveness and, a handful of cases across the entire country.
Yeah.
Doesn't seem right.
No. And an ultra low inflation rate to boot.
Yeah. So this is really interesting, actually. This is the chart showing how much of Eurozone government debt issuance the ECB bought country by country in 2020. And if you look at this, last year, the ECB actually bought over 150% of Greek government debt issuance. So it bought more bonds than were issued last year. And so it's massively compressing the yields.
Actually, likewise with Ireland, Keith. That's really interesting because Ireland is supposed to have made a sound economic recovery.
Yeah. So, I mean, the bottom line is that the Eurozone crisis, I don't think, has gone away. It's just being suppressed by the ECB. And when the ECB finally curtails its bond buying program and inflation expectations in Germany are rising quickly, as we covered last week, then I expect bond spreads to start widening again.
Yeah.
And on that note, this is the amount of government debt that is currently held by the central banks around the world. And you'll see all the central banks around the world have bought an absolutely frightening amount of total debt outstanding. So Japan, the central bank, owns 44% of all government debt, the Eurozone 42%, and then UK 36, US 23.
But Keith, that's quite interesting. So this is also one of those, we've been puzzling, if the US has these low interest rates and high deficits, why is the US dollar not falling? But if you look at this, you can see actually that it is the fittest horse in the glue factory. And of course, exchange rates are relative, not absolute. And so relatively speaking, the US is healthy.
Yeah, that's all true, Richard. But, you look at this and you think, why hasn't gold absolutely shot through the roof recently?
Well, I mean, yeah.
But now emerging market central banks have started to hike. So this is frankly not a very satisfactory chart. It is the percentage of central banks whose last rate move was a hike. And in the emerging markets, you can see about 50% of central banks have had a hike as their last move, whereas it's pretty much zero in developed markets.
Yeah.
But historically, the two have been linked. There's a strong correlation. So does that mean developed markets will now start a tightening cycle?
Depends which way the correlation runs, doesn't it, Keith?
Yeah, that's true. Well, this is a chart from the FT that is a bit of a mess. It covers a lot of data, but what it shows is the number of online job adverts for different sectors of the economy. And what I thought was very interesting is the difference between sectors. So the chart bottom right is transports, logistics and warehouse. And you'll see that it's gone up essentially 300% over the course of the year. Whereas the number of graduate jobs is flat. So some sectors of the economy are doing very well, but others really not so much. So if you're interested, take the time to have a look at that chart. Now, we've also had new data from the UN Food and Agricultural Organization on food prices, and food inflation has moderated over the last month, but remains very high. And that has been caused by a drop in the price of vegetable oils and cereals, but meat and sugar prices continue to rise. And that all matters because if you look at the real price of food, it's at the same levels it was back in 2011. And remember that during that period, high food prices in poorer nations caused a great deal of unrest and are one of the causes of the Arab Spring. So high food price inflation causes real distress in the developed world.
And this graph I thought was really interesting. It shows hunger is growing even in rich countries. So moderate or severe food insecurity in North America and Europe has gone from 7.5% of the population in 2018 to 8.7%. So what's that, a 16% increase? And that line is going up at a sharp angle. And in Italy, I'm sure this is indicative of the situation in many countries. The pandemic has pushed up poverty sharply, and this also leads to social unrest and as well as a lot of suffering. So I think that there are some stirring problems resulting from food price inflation throughout the world, probably.
Yes, and just anecdotally, Richard, my wife volunteers at our local food bank,
right.
And the queue over the course of the last few months has gone from, a few dozen people to literally out of the churchyard and along the high street. Yeah. So there's a lot of hidden distress going on.
Yes. Yeah. I think so.
Okay, moving on to equity markets. Well, the equity markets everywhere had a very strong week on the back of the US non-farm payrolls. So the all share was up 2.8%. The stocks Europe 600 also up 2.8%. I mean, for 1 week, those are big numbers. The S&P 500 was up 1.5%, NASDAQ up 1%, Japan's TOPIC index up 2.9%. So everywhere, equities had a very strong week. Bitcoin was up an amazing 17.5%, and I will leave Richard to talk about that. And sterling was flat to downish. Now, talking about equities, these are the earnings expectations for the S&P 500. And in the bottom chart, the black line is the forward expected 12-month earnings, and very strong. The question is this sustainable and realistic? Because when you look at the number of earnings beats, they're now fading.
It also harks back, I think, Keith, to the conversation we had at the start, where it was very noticeable that expectations for inflation rate effectively followed the rate of inflation. And you have to be a bit cynical about analysts, and basically what they do is they want to be in the middle of the pack. And if earnings are going up, they're not suddenly going to turn around and say, well, I think they're going to fall. They're going to try and reflect what recent history is. And I think that's probably what's going on with those earnings expectations.
Yeah, but the stock market is very elevated on the back of earnings expectations. And those earnings expectations just far too high?
Or is it elevated on the back of QE? I mean, are they Yeah.
But if you look at this, these are quarterly earnings in nominal terms. And you see that earnings have not only fully recovered, they're now at an all-time high compared to 1990 in nominal terms, but P ratios are also very high. So that you have to expect earnings to keep on growing very strongly from an all-time high in order to justify those very high PE ratios.
Also, and the constitution of the of the S&P has changed, hasn't it? And it now has the extraordinarily profitable Google, Apple, Microsoft, Facebook in it, and of course their margins are very high, and their marginal cost is very low. So how much that is skewing the figures vis-a-vis, say, 10 years ago, I'm not sure.
Yeah, because this is earnings revisions across the sectors, and bearing in mind what you've just said, Richard, you know, the materials and energy sectors are now a tiny portion of the S&P.
Yeah.
And what really matters actually is technology,
which
continues to have fairly strong forecast earnings growth.
So we need a weighted average figure there, would be useful.
Yeah. So actually, is there one? So that's the S&P 500 as a whole here.
Yeah.
So you're having earning expected these revisions. Okay, so as a result of all these very strong earnings, Wall Street analysts are very bullish. This is the percentage of their recommendations that are buy or overweight, and it's the highest it's been since 2002. So everyone is super bullish equities. But you know, this is the performance of the US equity market compared with emerging markets. And you see that compared to emerging markets, the S&P has done astonishingly well. So the emerging markets have lagged the S&P, and that's almost all because of very massive PE ratio expansion in the US. I mean, how long can that continue? But in the short term, there have been enormous inflows into US equities. $21 billion inflows per week, $4 billion per day.
So I don't quite understand this, Keith, because if I put $1 billion, which unfortunately I don't have, but hypothetically, if I invested $1 billion in the US stock market, I would have to buy some shares, and someone would have to sell me those shares, and they would take $1 billion out in cash. So it's an exchange, not a deposit.
Yeah, that's true. That is true.
I mean, obviously you've got new issues.
Also been a record.
Yeah.
No, but you're absolutely right. But this is flows into passive funds. So presumably, you're right. Somebody else is taking their money out. Richard.
Okay, so first graph of Bitcoin, which has bounced substantially since its low in mid-July 3000. It's up by 50%, in fact. And I think any head and shoulders that might have been there has been violated. And the next chart, Keith, is my favorite, which is Ether. And that's up about 65 or 70%, I think, from its low in mid-July. Got knocked yesterday, actually, but it's having a good day in the a good last 24-hour period. And then if you go to the log chart of Ether, which is the one I prefer, so I actually extrapolated this out in a very amateurish way. So you can see it touched the blue trend line of the log chart back in mid-July. And if you extrapolate up to the top of the red trend line, I estimate that if it hits the top of that line, the price will be around about $12,000 to $15,000. i.e. a 4 to 5-fold increase from here. Obviously, it's a big if. One of the things that's driving Ether at the moment is the fact that they are now burning Ether as opposed to issuing it. So the supply is getting less, although in fact there is no new supply. And also a lot of NFTs, non-fungible tokens, use Ether, the Ethereum protocol, as the mechanism by which they operate, which means that it's locking up Ethereum within those transactions. So the float, the free float of Ether, is not as large as it has been in the past. And that's another explanation that's put forward for why it is going to continue to go up and increase in price. I'm not an expert on the subject, so don't take my word for it.
Well, what I found really interesting about the performance of Bitcoin this week, Rich, is that we've had the news of this $600 million theft from an exchange, and Bitcoin has had a really strong week. So to me, it seems that, it's meant to be really secure, etc., but it ain't. You get these regular thefts. So
that's a good point, Keith.
Okay. On to commodities, and mixed week. So aluminium was down 0.6%, but it was very elevated still. Cobalt down 0.1%, copper down 0.2%, chromium up 1.7%, iron ore plummeted, down 11.2%. And if you remember, it was down last week as well on the back of Chinese curbs on steel mill output. And Chinese steel mills will have to actually cut their production in the second half. So iron ore prices are coming down very quickly. Lithium had a strong week, up 3.9%. Neodymium and nickel were both flat, as was ferrovanadium. WTI futures were up 0.7% on the week, which is quite surprising. Again, a volatile week. Now, a new addition to the checklist is Dutch natural gas futures. So the TTF is the Dutch hub, and that is for Europe. And we'll show you the chart of that, and that is going through the roof, up 3.1%. Coal continues to head for the stars. It's up 6.4% this week alone. And uranium is coming off, down 3.1%. So going through a few charts. Now, actually, before we do that, this shows the ratio of commodities to the Dow Jones. And what it shows is commodities have massively underperformed equities since the great financial crisis, essentially. And if you look back in history, there tends to be a cycle. So, commodities after a period tend to outperform equities when they reach lows like this. However, there are two ways this gap can close. The cycle can turn back up again. One is by commodities going on a very strong run, and the other is by equities collapsing. And we don't know which one is going to happen.
But it suggests, doesn't it, central bank is either has to maintain the equity indices by QE, which they will do, or and in doing so, they're going to have commodity inflation, or they let the equity indices collapse, in which case the economies will probably collapse. So I think central banks have no option, and it looks to me like commodity are a pretty safe bet for the next 5 or 10 years.
Yes, well, we obviously don't know at which point this graph will turn up, but you'd say in the medium term, it's likely to.
Yes.
And as if, a good hedge against inflation is commodities, real assets. So this is aluminium, which continues strong. This is a 10-year chart, and it shows the aluminium price is now the highest they've been in 10 years. This is cobalt, which is stable at recent highs. Copper is off its highs, but seems to have found a level. And just a reminder that copper is needed in vast quantities for the green energy transition, and this is the expected expenditure on wind power.
And there isn't enough copper.
Precisely. This is chromium, which has had a bounce, but is, unlike the other commodities, is well down from previous peaks. And this is iron ore, which
looking a bit like the lumber chart, Keith.
Yeah, it is. And frankly, if Chinese mills are having to cut their production in H2, this could go a lot lower. Lithium is ticking up. Neodymium is back at its previous highs, but was unchanged on the week. Nickel is trending back up, having had this big drop off in March. Now, as we've talked about previously, all the indications we've read is that nickel is actually an oversupply at the moment, but that's not stopping the price rising. Ferrovanadium is ticking up again. Crude oil is down from recent peaks, and the inventory draw in the US last week was essentially zero. Now, we previously talked about how market commentators were talking about draws of up to 15 million barrels a week during the driving season of August. And we are in the driving season, and the draw was zero, not 15 million barrels. And that is frankly bearish. It seems that the market has got ahead of itself, and the oil price hence has come off its highs. Now, this is the new chart this week. This is Dutch natural gas prices. Now, back in May 2020, gas prices hit a low about $1.50, and this is priced in dollars per million BTU, and it's now up tenfold. That's an absolutely enormous increase that is going to hit household budgets around Europe, and the chart of the UK natural gas price looks exactly the same. We have an interconnector with Europe, and we can export or import gas from Europe. So household energy bills are set to rise. Now, what's going on? In part, the recent news is that Gazprom have cut their exports to Europe via the Ukrainian pipeline by half in August as a result of a condensate fire at the Urengoy condensate plant. But the wider background is that we are encouraging the switch from coal to natural gas in order to reduce carbon emissions, but we are not encouraging an increase in capital expenditure to find new gas. So we have a structural problem with gas supply. And the commentary I've read is that we may well have a problem with these prices continuing into the winter.
Well, Keith, I was going to say that imagine this had happened in the winter, the price spike would have been extraordinary, because we're in the middle of summer, gas consumption is relatively low in Europe. So this doesn't bode well for inflation levels either, energy costs, household bills.
Absolutely. And when we were talking about poverty earlier, Richard, I mean, the two things that really matter are food and heat.
I think maybe we should invest in wool.
In what, sorry, Richard?
In wool, as in woolly jumpers.
And this is the coal price. Again, coal is just going through the roof, frankly. It's what, trebled in just under a year.
Yeah.
But uranium is coming off, and it's a good job you sold your uranium, Richard.
I'm very pleased I sold my uranium, Keith, and I am increasingly dubious that uranium is going to be a good investment. And I may be proven wrong, obviously, but nuclear power stations take years and years to build. Our energy problems are immediate. And I can't see that there's going to be such a vast nuclear building program that the existing world supply is not going to be able to keep up with it.
Well, the thing is, we've both heard for the last 5 years about this structural deficit developing in the uranium market. And, you know, we've had various ETFs listed to which just stockpile uranium to take advantage of it. And I see absolutely no evidence of it.
Yeah, I agree with you, Keith. You have convinced me.
Okay, so on to precious metals, and inflation came in hot, but the gold and precious metals generally had a poor week. So gold's down 0.3%. Silver had a bad week, down 4%. Platinum recovered a bit, up 4%. Rhodium and palladium were flat. So this is the gold chart. Now, its performance over the course of the week largely depends on where you start. So our numbers started from the close on Friday, but gold actually had an incredibly bad day last Friday when the jobs number came out.
Actually, Keith, this happened on Sunday night. So
right.
On Sunday night, shortly after the Asian markets opened, someone sold $4 billion worth of gold.
Wow.
Now, there are two reasons to do that. One is you have to sell it because you've got some huge financial difficulty. But even then, you'd have thought you'd wait until Monday morning or Monday morning in the US, or you want to bang the price down because you want to flush out a load of paper longs. And every commentator I've heard, including commentators who are dubious that the gold market is manipulated, have said there's no logical explanation for this other than someone was trying to flush out paper longs.
Wow. Okay. You'll see on last Friday, I take your point, Richard, that the big leg down was on Sunday night, but last Friday, when the jobs report came out, you had a drop of that $40 in the gold price.
Yeah, I agree. Okay, so this is a similar graph to the one that Keith showed of a global commodity, the overall commodity universe versus the S&P, but this is precious metals to the S&P, and it shows something very, very similar. They've also put some arrows in, sort of saying that when this ratio changes, it's good for gold. Well, that's fairly obvious, I guess, because gold's gone up. It is. You could call this a dodgy gold chart, and it's basically saying, "Hey guys, this is going to change around at some point, and when it does, gold's going to go up." But it does show that there is gold is relatively at an extreme low valuation to the S&P.
Yeah. Actually, I will think all this is showing that the US equity market is ludicrously overvalued. We talked last week about the number of companies with a price to sales ratio above 20.
Yes.
It's just totally unsustainable.
Yeah. Okay, another graph showing the price of precious metals versus M3, and the correlation is it's not great, is it? And it suggests that at the moment we would expect precious metals to start moving upwards to compensate for the increase in M3 over time. Silver got hit, didn't it? Silver got hit at the same time gold got hit with that.
Yes, but gold has recovered and silver ain't.
Yeah.
So actually, Richard, pause. Do you want to do these?
So silver is still, people say consolidating, but basically it's sort of dropping, isn't it, from its high last summer. It's sort of found a floor around about 23 at the moment. And I think that it is going to be going into some sort of structural deficit in due course over the next few years, but it isn't there yet. Platinum it has been on a significant sort of downward trend most of this year. from its peak at 1300. I guess it's being affected by the move to electric vehicles and people projecting there's going to be lower demand for catalysts. It is used in the production of hydrogen from natural gas, I think, isn't it, Keith?
Mm.
Rhodium fairly flat today, this week. Palladium the same.
Okay, finally on to rates, and the high inflation numbers and the strong jobs report were all bad for bonds. So we saw yields rise, but frankly, the extent of the rise was really pathetic. So UK 5-year rose by 7.5 basis points, 10-year by 7 basis points. And as a result, the UK 30-year, despite this week's rise, is still yielding well less than 1%. And you can see this is the chart of the UK 30-year. And after this week's bounce, it still looks really low. And this is a longer term chart, and UK 30-year yields are very close to their lows. They really have not recovered. So the bond market is not buying the reflation trade. And this is the US 10-year, which has had a stronger bounce, but still remains well below its recent highs. And onto the seasonality chart, which had a good week because it was predicting that equity markets would have a really good week, and they did. And now it's predicting they'll have a really bad week next week. So we will see.
I think you're getting ahead of yourself, Keith. I think we are currently the 13th of August. So it's saying last week wasn't very good, and this next week should be good.
Right. Well, last week was great.
Yes.
So, yeah, you're right. So anyway.
Well, it had to kill her, but we'll take credit for it anyway.
Richard, what do you want to update us on your activity?
So I had an uninteresting week in terms of my portfolio. Basically, it's unchanged on the week. Purchases. Well, I took advantage of the drop in the price of silver and bought the second tranche of silver call options that I was planning to buy. These actually expire in January 2023, so they've got 18 months to run. My first tranche are down substantially, I have to say. My timing was very poor indeed, but again, they don't expire until next July, so I have a bit of room to go. I have been buying Ethereum over the last couple of weeks, and I bought a little bit more last week, and that's it. I'm not going to buy any more. And I bought back into Galaxy Digital on the basis that I think cryptocurrencies are going to have a good run now. Galaxy Digital, which I did own and then sold, I think also responds well to increase in cryptocurrency prices, and no sales. So just on Galaxy Digital Holdings, it had a big retracement back down to this point here, and I bought it. I bought it around about here, I think. So I'm hoping that it's going to go all the way back up and above its all-time high. I may well be proven wrong, and I shall be here saying I sold it at a loss, but there we are. Keith, how are you? How about you?
Thank you, Richard. Well, I had, again, an indifferent week. I was up 0.8%, but again, underperformed the FTSE. So year to date, that takes me up 4.86%, still underperforming Richard, underperforming Stuart, and massively underperforming the all share, all of which is very disappointing. I had no sales, but I did do some purchases. So I bought a tiny amount of Taseko Mines, which we will be doing a share talk on today. And one of the charts we've introduced this week is of gas prices, which have absolutely shot up. And I have been looking around for a natural gas producer. Now, I have independent oil and gas in my portfolio, and it is due to produce first gas in Q4 this year. So I bought some more. I also joined Richard and Luke in buying the Malaysian online digital payments provider, Mobility One. And I'll briefly talk about that. And I bought some more gold plat, which had a recent update. So this is gold plat. It has a market cap around 12 million. It's got 3 million pounds in cash, and it made an operating profit last year of 5.3 million, which I think should equate to something like a post-tax profit of 3.8 million. So if you look at the earnings yield, and the management have now said that they don't need to do any more investment in plant and machinery, and so they're going to be paying out most of their earnings going forward in dividends. So once they resume dividends, I hope to see the share price do well.
Yeah.
This is Mobility One, which Richard and Luca both invested in, and it reported that its revenue in the year to end December was up 46%. It's also now established a relationship with MasterCard and joined the international payments network SWIFT. However, it has yet to produce its annual report for 2020 due to COVID disruptions in Malaysia. So that is something to be cautious about. This is share price of Independent Oil and Gas, and the share price is not reflecting the enormous increase in the UK gas price. And finally, Taseko Mines, which is listed in Toronto, that's the blue line, and in the UK, which is the orange line. And we will go into it, but it is a high cost copper producer with an enormous open pit mine and highly geared to the copper price. So anyway, I hope you'll all watch our share talk on that, which is coming up later today.
Thank you, Keith, for your update.
Okay, so thank you all for watching. Please can you press like and subscribe to our channel. And in the meantime, it is goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Bye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.